Bottom line, Friday, June 27th, Friday before the 4th of July, things are about to quiet down. Mortgage rates, long-term rates are back on their lows of the year. And despite the background noise of things are better, things are getting better, Fed's coming, inflation's coming, who knows what's coming, it really isn't changing much. The big, deeply confusing news of the week is the first quarter gross domestic product initially reported at break even, a decline of 0.1%, entirely ascribed to harsh weather in the Midwest and New England. The revisions continue to come in from the flash reports, and the one that came in this week is down 2.9% annualized for the first quarter. That's big dump. That's the worst since 2009 after Lehman. But upon further review, the GDP gets distorted by things like inventories. This is gross domestic product. If we produce inventories, even if we don't sell them, the inventories add to GDP, as they did last fall when things looked better than they really were. In the first quarter of this year, we didn't build much of anything, although we sold what we had. But that's a negative for GDP. We get slop in trade accounts that we don't really understand. Economies in Europe, most of the world, are heavily dependent on export trade. We're not. International trade is barely 12%, 13% of GDP, although it's growing. But in the first quarter, there was a sudden jump in imports and a decline in exports, a subtraction from GDP. GDP also distorted by consumer spending, trying to account for the sudden subscription to Obamacare insurance. Added what looked like 1% to consumption in GDP categories, revised to 0, no particular change. The bedrock in the U.S. economy is still the consumer. Its consumer spending is 70-odd% of the economy. Consumer spending in the first quarter, about a 1% annual rate. New voices say the economy is going to accelerate. Here it comes, guys. 5 years we've been waiting for it. Now it's here. Nah. The second quarter ends on Monday, June 30. And consumer spending looks as though it's better than it was in the winter, but is only maybe a 2% rate. We may pick up from 2% because of inventory building starts again. Maybe we export more, but the baseline of the economy is the same. That means the Fed's the same. The Fed's no closer to tightening today than it was 6 months ago. And so rates trickle off a little bit. Big deal. 4th of July, the Thursday before the 4th of July, the day before, 6:30 New York time, we get payrolls again, and for the month of June. And in thinly traded markets, when the gods of the universe of bonds are in East Hampton kicking sand into the faces of 98-pound weaklings, we could get a really surprise report that could move a lot, and nobody knows what's coming. See you next Thursday.